Welcome back, everyone. I hope that you had time to grab a coffee or even use the networking functionality which is available on this package. Before the break, you heard a very upbeat panel about the prospects for covered bond issuance in general in the CEE region. We're now going to focus on another very positive aspect of the market, which is the green market, the green covered bond market. I think it's an area which is particularly strong in the little issuance that we have seen in the CEE region for various reasons, which maybe we'll get onto. We'd also like to talk more in general about the funding of greenhouses in this area. To help me do that, you have the panelists that you see in front of you. Philip Bank is the head of sustainable bond origination at NordLB. Philip's been responsible for NordLB's first green fan brief and also for Deutsche Hypo's Green Bond Program. Jenny Johnson from the European Covered Bond Council, European Mortgage Federation, for the last several years now has been focusing on various energy efficient mortgage initiatives and has really been pushing the agenda on a Brussels level. Richard Kozecki is the head of balance sheet management for Slovenska Sportovnia. I probably pronounced that wrong, I do apologize. Who I think back in 2019 introduced the first benchmark AAA bond in the sector. And Katarzyna, and I'm certainly going to pronounce this right, Majewczak, the head of Treasury for PKO Bank. PKO has been a pioneer, I think, in the green covered bond issuance in the region and in Poland particularly. Thank you all so much for joining us today. Overall, we've seen a massive expansion in green covered bonds in general and in this region in particular. It's been extortionate rates of growth. Philip, can I start with you and ask, can this growth rate continue?
Yes, so thank you very much, Richard, for the possibility to be part of the panel today and discuss all the interesting things about the green covered bonds, especially in Central Eastern Europe. I would suggest that we will see the pace from the last 2 years regarding green covered bonds also in the next 3 to 4 years, due to different important points. So I think the most important point would be that, for example, in the last years we saw some inaugural green covered bond issuers, also like NordLB or, for example, ING in Germany, or also UniCredit in Italy, in Munich, which issued their first green covered bond. And all these issuers have the target not only to, let's say, for example, start with a test balloon and then see how the asset pool will develop and then maybe issue another bond in 2 or 3 years. So the issuers have the ambition to issue every year a new green covered bond. And so I think because of this fact, we will see from these issuers an ongoing supply also this year. So we think that all these inaugural issues are only the start from these issuers. I think another different point compared to the last years is that if we look back at the years 2016, 17, 18, also if we look back at Deutsche Hypo, so my former employee, I think at this time, the issuers only identified an asset pool of around about 600 million euros and then said, okay, now we are able to issue a green covered bond. But now we see that all these new issuers published asset pools which have the amount of more than 1 billion euros. And so I think that's also an important point, because we see that these issuers have a bigger funding potential regarding green covered bonds. I think the second important point are the green inaugural issuers who, let's say, went into the market with a senior. For example, like yesterday, the German CRE lender Areal Bank, they issued a senior preferred as in a green format. But at the end, this will also mean that this issuer will be able to issue green covered bonds. So because if they will finance a green building, then they will finance an uncovered part and also a covered part of this building. And so this will mean that also this issuer will be able to issue green covered bonds in the future, so in this year and also in the next years. Yeah, and I think there are also 2 other very important points regarding the pace of the green covered bond new issue volumes. The next one is that compared to the years 2015 to 17, there is now more know-how regarding the structuring of such programs. So there are more and more banks who offer this service to the issuers, as well as, let's say, private consultants, also like, for example, Dresden Sommer, the energy consultant, which structured the Green Bond Program, for example, also for PKO, which supported them. And so I think there is there are more possibilities to support the issuer with this product. And I think the last point, so the fourth point for this, for the increasing pace, is that we will see more and more TLTRO redemptions, and also that the issuers in the last year offered, let's say, more increased lending business. And so I think that we will see also in this year an increased amount of covered bonds and thus of green covered bonds.
So yes, clearly there's more issuance in general, and there's a lot of potential from the issues that you mentioned. But Cassie, I guess one of the drivers of the growth that we have seen is that it's economically worthwhile. Being cynical, there's clearly a greenium. I don't know how material that is, but is the greenium going to be significant? Is it a significant part of your decision process when you look at green covered bonds?
Yeah, I was thinking about it for quite a long time, and for covered bonds, the greenium is not a significant ratio. So, in fact, as Philip said, I think that the banks are very eager to issue green bonds in different format, covered bonds, non-preferred, and Tier 2. And when you are asking about how the supply will be looking like in the next years, I have some doubts about the green assets, whether the banks will be really ready to gather the green assets, especially in line with EU taxonomy. So with this limited pool of green assets, I wonder whether there might be some hesitance whether to issue the green covered bonds, or maybe it would be better to utilize this green portfolio to be refinanced by senior non-preferred or Tier 2 transactions, because the greenium is bigger there. So in terms of greenium, I would say that the more risky class, the bigger greenium is, and of course it will be a subject for the banking groups to decide how to utilize these green assets. As I work for the mortgage bank, and especially we are specialized in the residential mortgage, what I would be a bit afraid of is that there might be kind of a loop for the green residential buildings, which would comply with EU taxonomy and with the new standard. Because as you all know, starting from 2021, all the buildings have to be nearly zero energy buildings. And it seems that these energy standards are much more demanding than the previous ones. So, for example, in Poland, it's like 30% decrease in primary energy demand. And in fact, what we do see now is that most of the buildings which are being built now in Poland are based on the building permits granted before 2021. So they do not comply with the new energy standard. And the whole construction market, the developers, they will have to adapt to the new technical norms. And I'm afraid it may take like 1-2 years. And as far as I am in discussion with other banks from other jurisdictions, it's not only the problem in Poland. I think that there might be a scarcity of especially new buildings to be compliant with the new technical standards, and especially with EU taxonomy standards. So the greenium for the more risky classes is reflecting the higher margin. So of course, taking into account the covered bonds margins are really low. these days, of course, proportionally, the greenium is also lower than, for example, comparing to the margins on T2 and senior non-preferred. So this is the reason why it's not maybe that attractive to the issuers as for more risky classes.
Philip, I think you cover not just covered bonds, but also other asset classes. What do you think? Do you think this potential constraint of supply that Kasia mentions means, there's no constraints on demand, investors are begging for the bonds? Is this going to push up greeniums for green covered bonds?
So I'm totally fine with the answer of Kasia regarding especially senior non-preferred Tier 2 and also senior preferred, but I think we could also see a bigger greenium regarding green covered bonds if we will see green covered bonds which are in line with the European Green Bond Standard, so with the taxonomy. So like also Kasia mentioned, it's not so easy in many European markets, especially regarding green buildings, to be in line with the taxonomy. But it could be possible in different countries, for example, in the Netherlands, for example. And so I think that we will see, as I mentioned regarding the first question, I think we will see a continuing supply regarding, let's say, normal green covered bonds, where the issuer tries to develop own approaches, for example, also regarding top 15%. But I think if you will see some green covered bonds which are in line with the European Green Bond Standard, I would expect that we will also see a bigger greenium as, let's say, around about 1 or 2 basis points. So I think then it's possible, because there are so many investors like funds, but also banks, who need to be in line with the taxonomy, which must report a green asset ratio. And so I think there is a possibility to increase the greenium with such a special product.
Mm-hmm. Jenny, you've got your finger on the pulse in Brussels. Tell us about the EU Green Bond Standard and how significant that can be.
Thanks, Richard. Absolutely. I think I would completely agree with Philip that the Green Bond Standard, which is currently undergoing legislative scrutiny here in Brussels, is likely to be a game changer. It's likely to be, well, at least potentially, a kind of gold standard as far as the bond market is concerned. And I think there is an expectation that investors will likely favour those instruments that comply with the EU Green Bond Standard, because these bonds will be 100% taxonomy aligned. And so I think it's realistic to consider that, the measure of choice for issuers to evidence their EU taxonomy or the EU taxonomy alignment of their green bonds will most likely be the EU Green Bond Standard in due course. I mean, just to explain what the EU Green Bond Standard is very, very briefly, I think everybody knows that sustainable finance is a key priority, if not the key priority, for the European Union at the current time. And the European Commission considers that growth in the market for green bonds could really be a source of significant green investment, helping them to meet their European Green Deal targets. And so in recent months, they have turned their attention to essentially stimulating the market and providing what they consider to be a robust regulated environment for green bonds. And this, of course, is through the draft regulation for a voluntary EU Green Bond Standard. There are, I think, 4 key requirements under the proposed framework: taxonomy alignment, transparency, external review, and supervision of reviewers. Of course, exactly what kind of impact the Green Bond Standard will have will depend on the final shape of the Green Bond Standard. And we're actually lobbying very actively on this file at the moment, because there are some concerns. Name a couple. There is a 5-year grandfathering period for financial assets. So this means that financial assets risk losing taxonomy eligibility status after the 5-year period has elapsed. And so this, of course, is of concern. We're very concerned about the lack of security this could give to investors in green covered bonds. So we are proposing that EU green bonds should be grandfathered for their entire tenure, and that this should apply to both covered bonds and their underlying assets. And then there's another concern around use of proceeds. So the European Green Bond Standard requires that 100% of the proceeds of green bond issuance is be used to finance refinance taxonomy aligned assets. But meeting this requirement would require obviously huge volumes of mortgage loans, which would take years to accumulate to meet minimum issue size. And without, a certain amount of flexibility, it would take years before banks, and especially small banks, could actually issue an EU green bond. So we're proposing a kind of an 80% threshold for a transition period of at least 5 years, which could be extended to categories of assets which are not currently included in the taxonomy, to allow for this kind of critical mass to be built up over time. So we think, or at least from what I'm understanding as well from the market, that the green bond standard will be crucial, but exactly what kind of impact it will have on the market will depend on its final shape. And we hope to be able to to shape the proposal in the way that's necessary for the market to be able to continue to function efficiently and effectively.
I suppose that's because all of it is predicated on the use of proceeds model, and a green covered bond isn't a use of proceeds model. It's secured on green assets, and that's a fundamentally different thing.
Right, and this is it's a tricky question, and I have to be entirely honest with you, which is that we have discussed this at length, with different markets. I've just explained, the kind of proposals we're putting forward, but we're not, I think, 100% clear on what the implications of, the proposals around use of proceeds could be, the interaction with the grandfathering. It's not entirely clear, and I think that the more you dig, the more complex it becomes almost. So I think only time will tell over the next, couple of weeks and months, exactly what shape this will take. But we'll keep you posted, I would say. Hopefully, if we meet again in the spring, we can let you know where we are on this.
Yeah. Richard, I was speaking to someone a couple of days ago from a sovereign DMO who said there'll be less green sovereign bonds now because of the NGEU program. The NGEU program is funding in a lot of countries green assets directly from Brussels, and it's crowding out other forms of green bonds. 30% of issuance from NGEU is going to be green. Do you think that SSA green bonds crowd out green covered bonds?
Yeah, thanks, Richard. First, good afternoon from Bratislava. Yes, the EU is on course to be the biggest issuer of green bonds in the future. And in some ways, ESG SSA issue could be a good alternative to the green covered bonds. They are likely to be much larger, hence more liquid, and thus attractive to the interest rate funds rather than credit funds. They will be issued with maybe longer maturities than the covered bonds, and they may offer a similar yield depending on the exact issuer. On the other hand, as mentioned here, covered bonds have more substance behind because they are backed by physical assets. And there is close link between the covered bonds and the SSA issues. The covered bonds cannot trade too tight to the SSA's issues. There is a risk that if, for example, next generation EU bonds benchmarks will widen, covered bond spreads will be affected, of course. But in my view, the market is deep enough to absorb both, basically. As already mentioned, for banks as an issuer, the question is whether it is worth issuing green assets to issue covered bonds, or whether they rather use them for a senior preferred, senior non-preferred, or even tier 2, where the greenium is typically larger. For SSA issuers, there is not an option for that, of course.
Mm-hmm. Philip, what are your thoughts on SSA crowding out in general? And also, sorry, I want to give you an opportunity to comment on what Jenny said about the green bond standard, if you could give a measure of the importance of that.
Perfect, thanks. Yeah, regarding SSAs, I share the opinion from Richard. So I won't think that only because of the fact that the European Union will be the biggest green bond issuer in Europe or in the world, that we will have something like a crowding out effect. Because also of the fact that the most use of proceeds from ESG SSA issuers are different, in my opinion, to the green covered bond use of proceeds. So, for example, we here are more focusing with our bonds on, let's say, commercial or residential real estates. And the most SSA issuers are, in my opinion, more focused on general environmental things or also social things. And I think if you are an investor who is more focused on the different use of proceeds, and there will be a huge demand to, let's say, support the lower consumption of energies from the housing sector, then you will focus more on the, let's say, banks who are real estate lenders. And I think another point is also that the most banks are using a portfolio approach, where you have a portfolio, also a green asset pool of different, let's say, for example, green buildings. And so you are possible to calculate the avoided carbon emissions. And regarding SSA issuers, like, for example, federal states, I would suggest that that's not possible or not so easy, because most of these SSA issuers have a budget to finance things in the upcoming years. And I think for them, it would be better to issue under the transaction by transaction approach. And then it won't be so easy to calculate all the avoided carbon emissions. And also, if we speak about the green asset ratio, which I think is something also in line with the European Green Bond Standard, the green bond asset ratio is more and more important for the investors, and banks will be more, or banks must be, let's say, publish such a ratio in the future. So they could also maybe issue bonds which are linked to this ratio, and so they will be attractive for investors. And yeah, maybe as a last comment regarding the European Green Bond Standard, I think this standard will be very important in the future. And in 5 to 10 years, it will be, let's say, the best standard we will have. But due to the fact, which we also discussed some minutes before, that it's not so easy to be in line with this, we must wait until we will see the, let's say, broad mass of green bonds, which will be in line with the taxonomy and such, which will be European green bonds.
Cassia, do you have any thoughts?
Yeah, and I also think that we have to remember that the covered bonds are securitized, right? It is different than SSAs. So comparing, uncollateralized security to a collateralized one is something different. So, and we have to remember that there were times where covered bonds for some countries were trading inside government bonds. So I believe that still the green covered bonds have this value of being fully securitized and being this one of the safest asset class. So of course SSA has, as Richard mentioned, this huge liquidity, which is something for investors very well. But on the other hand, I believe that having a hard collateral on the real estate makes still very attractive for green covered bonds.
Jenny, you mentioned earlier about the conditions for the green bond standard. Green bonds are doing very nicely without the taxonomy. It's a market that's been around for several years now. It's been growing fast. Cassia mentioned already the problems with the assets. Are we going to insist on taxonomy compliance for all the existing programs, or do you think investors are going to be prepared to say we'll run with existing definitions, the underlying assets?
I think the taxonomy is really going to change the market. I think there are so many requirements, legislative requirements coming down the line, that it really is, I think, inescapable to a large extent. And I think certainly moving forward, I think we're going to see covered bond programs align as much as possible. I mean, from my understanding, in many respects, we are already seeing, for example, most sustainability bond frameworks of covered bond issuers using 15% best in class selection criterion for green building assets. Also, where issuers in their green asset portfolios, and it's not obviously the case that all do, they typically refer to a 30% improvement in energy performance okay, without the conditions that the technical screening criteria provide, which is a certain time frame around the upgrade being achieved, but nevertheless there is this 30% reference. And then for new construction, apparently there are very few frameworks that have separate criteria for these, but where they do, some actually already apply a stricter NZ criterion of actually minus 20% than the technical screening criteria. Sorry, nearly zero energy building criteria. So some of these programs actually apply a stricter criteria of minus 20%, so NZ minus 20%, than that which is currently required by the technical screening criteria, which is minus 10%. So there isn't necessarily a huge divergence from what we already have today with what the taxonomy will be requiring. But I think there is a general perception that covered bond issuers will update their frameworks to reflect the technical screening criteria. One point I would make here, and I'd be really interested to hear from the others on the panel, is the technical screening criteria are one issue. I think a completely different issue, and I know that this is an issue which is of much greater concern, let's say, to issuers, are the do no significant harm criteria, which are very, very invasive, let's say, and we're not entirely clear on how banks are going to have to evidence compliance, whether this be asset level, portfolio level, or something completely different. So we've got the technical screening criteria, that's one problem, but we have the do no significant harm criteria, and that's a whole other, problem, let's say. But I'd be happy to hear from others about the do no significant harm and whether they agree that this is kind of where the big concerns or headaches lie.
Well, Richard, can I ask you that? I mean, two separate questions there, really. One, the point Jenny just made about no significant harm, and then the other one are just the sheer practicalities. You've got this complicated piece of legislation coming out of Brussels. You've got this big mortgage book. How do you make them work together? Practical terms.
Yeah. So first off, on the do no significant harm criteria, to be fully compliant with the EU taxonomy, there is more environmental data needed than just the EPC. I believe this will be the issue. For the old buildings or existing buildings, this is doable, of course. For the renovations and the new buildings, I believe that we will take some pragmatic approach there, because to collect all the necessary data from the client or from the project, it will be very, very challenging, in my opinion. On the second question, the practical issues with linking the mortgage books with all the conditions, as we have a new framework and the selection criteria based on the most recent available data, and also taking into consideration our conservative approach in mortgage selection, most of our eligible green mortgages are in line with the technical screening criteria. What is challenging in our case is still the data availability, including the link between the government and the bank database. This is especially important in case of major renovation, where you basically need two certificates, initial and the new one. But concerning the EPC, for time being, we are downloading it from the Inforec webpage, which is some kind of state information portal under Ministry of Transport and Construction of the Slovak Republic, which is open for the general public, but with limited data only. You can see there the EPC number, the building description, the building address, the plot, parcel number, EPC validity, primary energy, total energy. But EPC from the web page must be transformed into the database form and then matched to the bank collateral database, which brings some discrepancies and ambiguities. What we are missing here is a title deed number, which is the unique identifier for each real estate property. Our intention is to add the missing data information and gain then the somehow automatized access to the EPC database in the future. Currently, from 180,000 of residential mortgages, we have approximately 50,000 of EPCs, which means slightly less than 1/3 of the total portfolio. Other way how to get EPCs to change the business process and require EPC directly from the client, which is not a business standard yet, and it also goes against the loan process simplification and digitalization. In this, I very much welcome actually the EU-wide activities, for example, the proposal of directive on energy performance and buildings, with objective to increase the rate and depth of renovations, but also to improve the information on the energy performance of the buildings. And if I'm correct, for example, to ensure the comparability across the union by 2025, all energy performance certificates must be based on the harmonized scale of energy performance classes, plus member states shall set up the national databases for energy performance certificates of buildings, which will allow us to gather the data related to the building renovations, for example. In our bank, we are currently working on an automatized data solution and processing from our green mortgage portfolios.
Kasia, from your point of view, similarly difficult practical problems there?
Yeah, I would say even more in Poland, because we do not have a public database of EPCs.
Right.
And there are also no classes of EPCs in Poland. So we have come up with our own methodology, as Filip mentioned, prepared together with Dries and Zome. So it is mostly based on technical norms binding for different periods of time. But yes, what we do hope for is that it will be harmonized to the European Union. There are also some problems with processing the data from the EPCs because you have this General Protection Directive, so you cannot process the personal data of people, so it has to be also taken care somehow. But for the do not significant harm, I can hear more and more voices from the market that yes, it looks extremely complicated from the regulation point of view, but further on, probably we do expect that EBA will give some guidelines how to treat it, and just looking at it rationally, probably if you do comply with all the laws for if you do have the building permits, you have all the laws being in line with construction law and environmental law. I believe that most of this do not significant harm can be taken care by, saying that if you are not against the law, you probably are fulfilling it. But of course, we need to wait for the further guidelines, because otherwise it looks extremely complicated. But solution for this, and maybe at this point of time it looks very difficult, but probably within a year or two we all will be okay. So yeah. For us, the biggest problem is the lack of database for EPCs and the difficulty to process them.
Jenny, this is a problem that probably many of your EMF members come across, and actually, Filip, a lot of your clients come across. What can either of you do from a practical point of view to try to help potential green bond issuers? Jenny, can you go first?
Yeah, of course. In fact, I think we've gone kind of 40 minutes and I haven't mentioned the Energy Efficient Mortgage Initiative once yet, Richard. So this is definitely the chance to do that. It's a record. So, I mean, this is absolutely a fundamental problem, and one that we recognised very early on. And so through the Energy Efficient Mortgage Initiative, we've been really paying a lot of attention to this. So clearly, lack of data on the credentials of the underlying assets, big problem. Many properties simply don't have an EPC. There's limited or no access to EPC data registers to build the profile, what we've heard already from the other colleagues. So our approach here has been twofold. Firstly, through the Energy Efficient Mortgage Initiative and the Energy Efficient Mortgage Label. We're setting a quality benchmark based on the EU taxonomy. So we're providing the tools for banks to be able to collect relevant data through a master template to originate new loans and tag existing loans, and then disclose relevant data in an aggregate form through the HDT, the Harmonized Disclosure Template, which is designed to complement the covered bond label's HTT. Mm-hmm. So that's building the infrastructure, really, just helping banks to know what kind of information they should be collecting. Whether it's there or not, that's a separate issue. We've seen some really great work in banks, for example, OP Bank in Finland, where they don't have access to EPC, so they've built a kind of proxy internally to map their mortgage book. So they really are finding alternative ways, to get around this lack of a centralized database or access to EPCs. The second line of attack is to actively work with the EU and national authorities to centralize EPC data and make it publicly available. And so we're seeing real progress being made here, both at national level, for example, in Belgium, where there's a real discussion going on now with the national authority, which wasn't taking place 3 or 4 years ago, and also at EU level. And Richard mentioned the Energy Performance of Buildings Directive and the progress that's being made there. What we're also trying to do is get to the grips with these GDPR problems, so the data protection problems that Cassia mentioned. So we've recently commissioned a law firm to, look at what kind of data we should be collecting, what the legal basis is, how to be compliant, what happens in case of, where are the liability issues. And we have 3 legal opinions in our hands that we'll be publishing and presenting in a few weeks' time. So we're trying basically to cover all our bases here, and we think that this kind of combination of approaches will really help to address some of the practical challenges that we've mentioned here. Thanks, Richard.
Jenny, this is also where you're supposed to plug the Bauhaus Program.
Yeah, I should have said, well, we're actually going to present these legal opinions at the Bauhaus and now I don't have the date in mind. I think it's I'll come back to you with the date. Sorry.
It's a more general comment that the EMF ECBC's Bauhaus initiative has a series of presentations on practicalities of this general topic from the various firms that are working in this area, and it's well worth looking at the website to see that. Philip, sorry, is there anything that you can do from a practical point of view to help issuers? And why don't I do 2 questions for the price of 1, because we've had a great question from the audience. Asking why aren't all assets, not just mortgages, that are taxonomy compliant, eligible to back covered bonds? So 2 questions for the price of 1.
Okay, perfect. Thank you very much. So maybe as an answer how we could help other issuers, I think the first point which all issuers can do is to, let's say, work together, maybe also via the ECBC or also via the national associations. For example, or in Germany from the Pfandbrief banks, or maybe also in Poland, there will be a national association, because I think the first benefit for the investors would be that the investors can compare the, let's say, selection criteria and also the calculated avoided carbon emissions from all the different national covered bond issuers. So I think the first step could be that the issuers work together. Because maybe also if we take CEE as an example, PKO worked together with Dresden Sommer regarding the top 15% approach. So it's possible that there is also a different issuer who is active in the Polish lending market, and it's possible that this issuer works together with a different energy consultant, and maybe this consultant will calculate a different top 15% benchmark. So I think this could be a bit confusing. This won't be, in my opinion, not a benefit for the investors, because they cannot compare the issuers. So I think the first most important point would be that the issuers work together via, for example, the ECBC or the national associations. And yeah, regarding the question, why aren't all assets, not just mortgages, that are taxonomy compliant eligible for funding via covered bonds? I would say let's say, easy answer is that not every covered bond law allows every project, every loan to be refinanced via a covered bond. So for example, in Germany, it's not allowed to refinance renewable energies with or via covered bonds, because you don't have the security like you have with a mortgage. You only have the cash flow, for example. And that's the answer at the end why you must use then a senior preferred, for example.
But Jenny, do you think that there's a case to change covered bond laws to add a new category to Article 129?
That's a question.
Put you on the spot, why not? Yes.
I'm not sure I'm the best person to answer that, to be honest. I think there are attempts in other markets, right, in other jurisdictions to. I think there's a certain purity and a certain perimeter, let's say, that the covered bond community is quite keen to maintain, and I think there's a certain reputational, benefit linked to this, and so I think there may be resistance to extending this perimeter too far, but perhaps others are better qualified than me to comment on that. Just one other point that I wanted to make, if I can quickly, Richard, on the 15% point that Philip made. I think it's a really very important point, that we should, as an industry, as a community, be trying to, put forward solutions which respond to a particular challenge. And actually, through the Energy Efficient Mortgage Initiative, we are working with an expert company on designing and delivering a methodology to identify 15% best in class of the regional or national building stock in line with the EU taxonomy. We're starting with Italy. Italy's our test case, but the idea is to design a methodology which is replicable in other markets, other jurisdictions. So we're really trying to do this through our initiative and through our national hubs. So just to respond really to your point, Philip, there's something that we're trying to do actively. So we'd be very happy to keep you, apprised of our progress there. Thanks, Richard.
I think the question about Article 129, sorry to put you on the spot, but I think that it's something which does need a much broader debate. And thank you for that question. Any other questions, please do pop them in the room. We're running a bit short of time, having said that, but one topic that I really want to talk about is the risk weightings of the underlying assets and the risk weighting of the bonds backed on them. And now, Jenny, Cassia, I know that you both looked at the correlation between the energy efficiency and the risk weightings. How much evidence is there? How much evidence do we need to be able to persuade for a different risk weighting for energy efficient mortgages?
Shall I go first, Cassia, or would you like to?
Yeah. Please go first.
So, I mean, this is a really important element of our work, or has been a really important element of our work. We, as I think everybody knows, we've done an extensive research into the correlation between building energy performance and credit risk. We found a statistically significant negative correlation between building energy performance and credit risk, which also shows that the degree of energy efficiency matters. So the more energy efficient, the lower the credit risk. I could go on. We've done this in a handful of markets. I think 5 markets now. There are other initiatives which are producing very similar results in other jurisdictions. So there's a really a big movement, let's say, that's happened and that's still continuing. But the really significant thing is that the European Banking Authority has been given a mandate through the CRR, through the Capital Requirements Regulation, Article 501, which was very much kind of pushed through the European Commission's Sustainable Finance Action Plan, to examine basically all of this research and the case for a privileged treatment, let's say, for assets with an ESG flavor to them, let's say. And so I think what we've done, Richard, is we have collected a sufficient amount of compelling evidence to have put the spotlight on this issue. 7 or 8 years ago when we started this adventure, it was, let's say, the Valhalla. It was where we wanted to go, but we didn't have, a clue how we were going to get there. And we thought it was such, so out of reach. And here we are today in 2022, and it's closer than we could ever have imagined, I would say. The European Commission, basically the mandate was supposed to end in 2025, but the European Commission has asked the EBA to speed up its work, bring forward the publication of the results to 2023, which kind of shows how important the European Commission considers this to be. So we don't know what the final outcome will be, but certainly the discussion is taking place. What we've also seen in the proposal for an amended CRR, which was published in October, is a reference to energy efficiency specifically in relation to upward revisions of the value of the property, so the V in the LTV. So energy efficiency is unequivocally recognised as driving value upwards, which is a really important recognition of our work there and the research that we've done. So I think we've done exactly what we hoped we've achieved exactly what we hoped to achieve, which is to really put the spotlight on this and create this movement, let's say, and let's see now where this takes us.
Cassia?
Yeah, and what we also were discussing with Jennifer is what can be done more on bank side. And let's assume that this preferential capital weights will become a real life. Then what has to be done, and I believe it has to be started now, is the internal work on the banking side, because the banks now, I believe, they do not have they just don't know what kind of assets would be treated with this preferential weight. So we need to internally have the system in the bank how to label these assets which would potentially be treated with this preferential capital weights. And I think it will take like at least 1 or 2 years for the banks to identify each asset, and it is also what the banks have to do for reporting GAR. So I think that the external work has already been done, and now what has to be done is that the banks have to implement their own solutions, how to label and how to assess which assets potentially could be treated in preferential way and are in line with EU taxonomy.
So again, back to a practical problem. And Philip, how material will it be, do you think, for investors, for banks?
I think it will be very important, but I'm not sure whether, let's say, green assets, green buildings, for example, offer a lower risk due to 2 different points. So because 2 years ago at Nordeby, we analyzed our real estate loan portfolio. And due to the market conditions that the market values of the buildings are increasing, you cannot offer, let's say, a very good proof that there is a lower risk of a green building. Because, for example, we saw also that market values as well as vacancies increase, and that's not possible if you analyze this building in general. Because if the vacancy increases, the market value must decrease. And I think another point is that if you will develop a green building with many different techniques to, let's say, offer low energy demand, you will use, let's say, the best high tech which you can have. But this could mean at the end that you have higher overhead costs. This could be also a risk, for example, for the owner of the building. So I'm not sure whether we see or whether we could see a lower risk of these buildings, because this building can be more expensive. And I think we will see also the same regarding renewables, because we think that renewables are very, let's say, sustainable. I think that's right. But because in the last weeks or months, due to the increasement of energy prices, we saw that there were many customers who were, let's say, for example, renewable energy developers who worked with forward contracts. And due to the increasement of prices, there were many of them who went in default. So I think it's not so easy to say in general that every sustainable loan will offer a lower risk.
And clearly more work is needed on that. Jenny, we've had one more question. We've got very little time left, but I do want to ask you this question on exactly this point. You spoke about, was it the EBA bringing that forward to 2023? As somebody from the audience has pointed out, Hungary already has different risk weighting allowances for green mortgages. Should this be an EU or a bar competency, or is it up to our friends in the Hungarian National Bank? You're on mute.
Absolutely, it should be. It is currently under discussion at EU level, and let's see, as I said, where this will take us. What the Hungarian central bank has done has really, they've moved ahead. They've broken away from the pack. They were very, very involved and very interested by the work that we were doing, and they decided to take one step forward a bit faster than everybody else, because we all know that, of course, that things take time in Brussels, and you know, there's a big focus on evidence-based policymaking, et cetera, et cetera. So, you know, you can't do these things overnight. And so, I mean, we're extremely, extremely interested and impressed by what the Hungarian central bank has done. And in a way, it's a great development because it's a test case. You know, it's almost, you know, gives us additional leverage with the European Commission to say, you know, look at what Hungary's doing, and it's successful in Hungary. They've just extended the program. They've just made the program even more attractive to banks to try to get kind of more to build more interest and more uptake. So. As far as I'm aware, they've recently extended the project to include renewable energy loans and corporate green bond exposures. So, I mean, it seems to be, for the time being, you know, a successful venture, I would say, from their part. And we're in regular contact with them to understand, you know, what they're doing. They're also members of the network for the greening of the financial system. So they're obviously sharing their intel with, you know, global central banks. So. They've been very brave. I think as I said, they broke away from the pack, and hopefully they'll be a good example for the EU and other central banks.
I'd love to follow up on that point and a couple of other points that frankly, we've left hanging and we haven't had time to pursue. We have actually run out of time, unfortunately, so we can't pursue that. We will have plenty of other opportunities. I know that we're going to hopefully have in Athens, I believe, the plenary of the ECBC. Fingers crossed that can happen. And we'll certainly have panels on this in the September conference, which hopefully will be September Covered Bond Conference, which hopefully will be in Vienna on the 22nd of September. Please keep that date in your diary. I'd like to basically finish by thanking the EBRD and the ECBC for their support, and Helaba, Moody's and Nord LB for the sponsorship of the Covered Bond Briefing again this year and for all the events. Over the next few months, we won't be having any physical events, with the possible exception of Athens. Euromoney are going to be having a series of covered bond roadshows, monthly sessions like this, focusing on specific parts of the market. We're going to start that up in March, so we will be receiving an email telling you about the program that we're putting together for that. Both of today's panels are going to be available on this platform for any colleagues who want to see it. If you missed the first one, please do urge you to use that to look at this. They're going to be available from tomorrow, so please use that. Thank you very much for watching, for following this afternoon's events, and thank you once again to my panelists for today's participation. Hopefully see you all in person very soon. Thank you.